When you spend decades accumulating nest egg savings, shifting into the distribution phase can feel unnerving. For decades, the rule was simple: save as much as possible and let compounding do its work. But once work stops, the rules completely flip. Now, you are forced to navigate a maze of IRS schedules, age triggers, tax brackets, and penalty traps. The primary issue many pre-retirees and retirees face is a fundamental lack of clarity surrounding how and when they can legally access their money without incurring massive penalties or unexpected tax bills. The fear is entirely justified. Pulling money out too early can result in a harsh 10% early withdrawal penalty, while waiting too long or miscalculating a distribution can trigger a devastating 25% IRS penalty. On top of that, taking distributions incorrectly can push you into a higher federal income tax bracket, trigger higher Medicare premiums through income-related monthly adjustment amount surcharges, or cause up to 85% of your Social Security benefits to become taxable. To master retirement account withdrawal rules, you need to understand 3 core timelines, how different account types are treated, and the practical strategy for pulling income efficiently. The first major milestone is age 59 and a half. Before this age, withdrawals from traditional IRAs, 401(k)(s), and 403(b)(s) are generally classified as early distributions. If you take money out before 59 and a half, the IRS typically hits you with regular ordinary income tax on the amount plus a 10% early withdrawal penalty. However, there are key exceptions you should know. Under the rule of 55, if you leave your job in or after the calendar year you turn age 55, you can take penalty-free distributions directly from that specific employer's 401(k) or 403(b) plan, though ordinary income tax still applies. Another pathway is substantially equal periodic payments under Rule 72(t), which allows penalty-free early access if you commit to a strict multi-year distribution schedule based on life expectancy. The second milestone is the flexible gap between retirement and age 73. Once you reach age 59 and a half, the 10% penalty completely disappears. You can withdraw as much or as little as you want from your traditional tax-deferred accounts. This stage represents your primary window of opportunity for proactive tax planning, such as executing partial Roth conversions at lower tax rates before forced distributions kick in. The third milestone is age 73, where required minimum distributions, or RMDs, begin. The government allowed your traditional retirement accounts to grow tax-deferred for decades, but at age 73, they require their share. You must calculate your annual RMD by taking your account balance as of December 31st of the previous year and dividing it by an IRS life expectancy factor. If you fail to take your full RMD on time, the penalty is 25% of the amount you failed to withdraw, though it can be reduced to 10% if corrected promptly. Understanding how your specific account types function under these rules is equally vital. For traditional IRAs, 401(k)(s), and 403(b)(s), every dollar withdrawn is taxed as ordinary income. If you have multiple traditional IRAs, you must calculate the RMD for each IRA separately, but you have the flexibility to pull the total calculated amount from just one IRA or spread it across several. However, workplace plans like 401(k)(s) do not allow aggregation. You must satisfy each 401(k) RMD from its respective account. An important exception exists for active workers. If you are still working past age 73 and do not own more than 5% of the business, you can generally delay RMDs from your current employer's active 401(k) until the year you actually retire. For Roth IRAs, the rules are significantly more flexible. Original account owners are never subject to lifetime RMDs. Furthermore, employer-sponsored Roth 401(k) and Roth 403(b) accounts also do not require lifetime RMDs. Because you contributed after-tax dollars, you can withdraw your principal contributions from a Roth IRA at any time, penalty-free and tax-free. To withdraw the growth or earnings completely tax-free, you must be at least 59 and a half years old and satisfy the 5-year rule, which dictates that 5 tax years must have passed since your first Roth IRA contribution. The key actionable takeaway for securing your financial retirement is to establish a proactive withdrawal sequence rather than pulling funds at random. Start by auditing all existing retirement accounts, noting their specific types, tax treatments, and current balances. Second, structure a tax-efficient distribution strategy across your 3 potential buckets: taxable accounts, tax-deferred accounts, and tax-free Roth accounts. In early retirement, drawing from taxable accounts or filling lower tax brackets with tactical traditional IRA withdrawals helps preserve your tax-free Roth assets to compound as long as possible. Third, evaluate qualified charitable distributions if you are age 70 and a half or older. A qualified charitable distribution allows you to transfer up to $100,000 annually directly from a traditional IRA to an eligible charity, satisfying your RMD requirement without adding a single dollar to your adjusted gross income. By aligning your income needs with age triggers, tax brackets, and proper distribution sequences, you transform complex account rules into a structured roadmap that protects your savings, minimizes unnecessary taxes, and secures long-term peace of mind throughout retirement.